Welcome to the Limitless Retirement Podcast. My name is Danny Gudorf, the owner of Gudorf Financial Group. Whether retirement is on your horizon or you've already made the leap, this podcast tackles your most important questions in retirement. Every episode, I'm here to share valuable tips and strategies to help you succeed in retirement. So let's go ahead and get started with today's show. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer, member FINRA/SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated. Many retirees make a costly mistake that could leave them broke in their final years. They believe the safest approach is to only spend dividends and interest from their portfolio while never touching the principal. This sounds smart and responsible, but it's actually one of the most dangerous strategies you can follow in retirement. Today, I'm going to show you why this income-only approach puts your financial future at risk and reveal the strategy that wealthy retirees actually use to make their money last longer. Hey there, I'm Danny Gudorf, founder of Gudorf Financial Group. And for over 15 years, my team and I have helped clients over 50 build a limitless retirement. We specialize in helping people transition from saving for retirement to actually living in retirement with confidence and clarity. If you've been told to live off dividends and interest alone, you're not getting the full picture. This old school thinking feels safe because it seems like you're preserving your money, but research shows it often leads to the exact opposite result. When you focus only on income, you end up chasing higher yields, which means taking on more risk precisely when you need stability most. You also sacrifice diversification by loading up on dividend-heavy stocks and high-yield bonds that might not perform well during market downturns. Let me explain what total return actually means. Total return combines two things: income from dividends and interest, plus capital appreciation or the growth in your investment's value. An income-only investor tries to cover all expenses solely from dividends and interest, keeping their principal untouched at all costs. But here's the problem with this approach. Research consistently shows several major pitfalls that can destroy your retirement security. First, you end up with too much concentration in high dividend sectors. When you need a certain amount of income and your portfolio only yields 2%, you're forced to chase higher yields. This often means moving into riskier assets like high-yield bonds or dividend-heavy stocks, increasing your portfolio's risk when stability matters most. Second, you face increased volatility during market downturns. Dividend-focused portfolios often perform worse during bear markets because they lack the diversification needed to weather different economic conditions. Third, you have way less flexibility in your spending. If your dividends get cut during a recession, you're stuck with reduced income and no plan for making up the difference. The income-only mindset persists mostly due to emotional biases that feel comfortable but work against your best interests. There's mental accounting, where you feel safer spending dividends rather than selling shares. Even though economically they're the same thing, loss aversion makes selling shares feel like losing money, despite the math being identical to receiving dividends. And anchoring keeps you stuck with familiar dividend stocks because they feel safer due to historical comfort, even when better options exist. Let me show you why total return is better with a real example. Imagine you have a $2 million portfolio and want to withdraw $80,000 annually. That's a 4% withdrawal rate. If your portfolio yields just 2%, you only have $40,000 in income. Where does the remaining $40,000 come from? Income-only investors might chase higher yields, moving into riskier assets and increasing portfolio risk when stability is most needed. A total return approach provides more options and better results. With total return, you get flexible withdrawals where you can draw from both dividends and appreciation, allowing for more strategic decisions. You lower risk by avoiding yield chasing and maintaining broad diversification. You also get improved tax efficiency because you can optimize withdrawals for tax advantages. Research from the Financial Analyst Journal shows that total return portfolios consistently demonstrate higher sustainability and better management of market volatility compared to income-only portfolios. Successfully implementing a total return strategy during retirement means structuring your withdrawals thoughtfully and managing your portfolio strategically. First, determine your withdrawal needs clearly by identifying your required spending each year in dollar terms to support your desired lifestyle. This way, you won't anchor your withdrawals to dividends or yield. Instead, you focus on your real-world expenses. Second, strategically rebalance your portfolio, sometimes taking taxable gains. You regularly rebalance to generate cash flow, naturally prompting you to sell investments that performed well and buy more of those that haven't, keeping your portfolio aligned with long-term objectives. Third, maintain an adequate cash buffer. Different people have different opinions on how big this should be, but having 1 to 2 years of expenses in cash reduces psychological stress from market volatility and helps avoid selling assets at depressed values during downturns. Fourth, optimize your tax situation always. Hold income-generating investments like bonds and tax-deferred accounts while placing investments with more favorable tax treatment, like index funds with minimal income payments in taxable accounts. You can also tax loss harvest regularly to enhance tax efficiency. Most importantly, think about your portfolio in a complete way. Avoid treating dividends or interest as the primary driver of your retirement strategy. Instead, view your portfolio as a total return vehicle designed to sustainably support your spending needs, manage risk effectively, and adapt to changing financial circumstances. This approach maximizes reinvestment, harnesses compounding growth better, and provides greater long-term financial stability. The evidence is clear. While the income-only approach might seem comforting, it often creates unnecessary risks and limits your financial flexibility. A total return approach provides superior diversification, flexibility, and long-term portfolio sustainability. Your portfolio's purpose is to support your goals, not just yield dividends. When you understand this difference, you can make smarter decisions that help your money last throughout retirement. Remember, the wealthy don't get wealthy by playing it safe with outdated strategies. They use approaches that actually work based on research and evidence, not just what feels comfortable. Total return investing is one of those strategies that can make the difference between running out of money and having financial security throughout your retirement years. The key is starting with the right foundation and understanding that your retirement success depends on total portfolio performance, not just the income it generates. When you shift your thinking from income only to total return, you open up possibilities for better outcomes and more reliable retirement income that can adapt to whatever the markets throw at you. Now that you understand why total return beats income-only investing, you need to know exactly how much you can safely withdraw from your portfolio each year. If you want to learn the withdrawal strategy that wealthy retirees use to make their money last longer, while poor retirees struggle, click right here. Thank you for listening to another episode of the Limitless Retirement Podcast. If you want to see how Gudorf Financial Group can help you get the most out of your money, go to gudorffinancial.com/get started. This is where you can schedule a 20-minute call to see how our firm can help prepare a free retirement assessment. Please remember, nothing we discuss on this podcast is intended to serve as advice. You should always consult a financial, legal, or tax professional that is familiar with your unique circumstances before making any financial decisions. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer, member FINRA/SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated.